Greetings from Winston-Salem, and on behalf of our team at Pro Benefits here and Points Beyond, we welcome you to our regular client webinar in our February session, which is the first one of 2020. Hope that you'll find this helpful. In a moment, I'm going to welcome in Laura Bibb, who's our Senior Compliance Counsel, and John Caldwell, Compliance Specialist, who will present today's topic, which is an update on flexible spending accounts, including an update on discrimination testing for plans with FSAs, coordination of flexible spending accounts, particularly the health FSA with HSA bank accounts, and some other current issues. Your questions are welcome during the webinar, and the best way to submit those questions is through the question box on the control panel, as well as after the webinar. The best way after the webinar is to submit those questions to compliance@ProBenefits, compliance@ProBenefits, and our team will be happy to help you in any way that we can. Thank you for joining us today, and again, hope you find this session helpful as we cover these topics, and I'll turn it over to Laura Bibb.
Thanks, Jason, and welcome everyone. I hope 2020 is treating you well so far. Today we are going to, as Jason mentioned, review some common FSA questions, provide you with an update, and also provide an overview of our new testing process, although some of you may have already experienced it in action, and then talk about the interaction between FSAs and HSAs, since we've had several questions recently as plans are adding HSAs, just about the interaction between those two plans. And then we're going to answer your questions at the end of the session. So just as a reminder, Section 125 plan has many names: cafeteria plan, flex plan, but the basic premise is that employees are allowed to pre-tax deductions for their benefits, and there's a tax savings for both the employee and the employer. There are two basic types of plans. A premium-only plan, that's really the most basic type of Section 125 plan, where employees are only pre-taxing premiums for their benefit plans and HSAs, if there's an HSA present. There's also the pre-tax premium plan plus a flexible spending account if an employer has an FSA, a limited purpose FSA, or a dependent care FSA, or all three of those. So there are two options for the health FSA. You can have a health FSA that might be a full health FSA, or sometimes called a general purpose FSA. And then there's also a limited purpose that would only reimburse dental and vision expenses. We also have dependent care FSAs. These are for work-related child care expenses. We're not going to talk about those today, but I just wanted to put that out there as a reminder that is a type of benefit that's offered under an FSA Section 125 plan. The FSA is reimbursing out-of-pocket medical expenses. So if it's a full FSA, that will generally be your Section 213D expenses. And then the limited FSAs are going to be limited to dental and vision expenses. So one of the common questions that we had at the beginning of the year and sort of towards the end of the year is the health FSA maximum for plan years beginning in 2020. For at least the last, I believe, 2 years, the IRS has been fairly late in releasing what the plan year maximum will be, but we've seen consistently it's been a $50 increase year to year. So there you see that the 2020 health FSA plan year maximum is $2,750, and again, that's a $50 increase from 2019. We also have the option for a $500 carryover, and that is not included in that plan year maximum. So it could be $2,750 plus the $500 carryover. There are legal requirements for a Section 125 plan, and these apply to all Section 125 plans. Sometimes we get a lot of questions about whether ERISA applies, does the code apply? So these are code requirements here that you see under the Internal Revenue Code. And the first requirement is that the plan year is 12 months unless a short plan year is used. So typically we see employers using a 12-month plan year, although a lot of times we see a short plan year if an employer is beginning an FSA for the first time, or they're looking to move their FSA from, say, a calendar year plan to a fiscal year plan. And as a reminder, elections cannot be changed mid-year absent an allowable qualifying event under the IRS rules. We see lots of questions about that. One question we get quite frequently is the financial hardship question. If an employee is having a financial hardship, can they change their election? And that is not one of the recognized qualifying events under the IRS regulations. So there's a lot of misunderstanding about that out there. And again, under the Internal Revenue Code rules, there are non-discrimination requirements. We're going to talk a little bit about this later. John's going to go into our new process and provide you with an overview of the testing requirements. And again, health FSAs can only reimburse out-of-pocket medical expenses that are allowed based on either plan design of whether it's a full FSA, a limited purpose FSA, and those expenses can't be reimbursed from some other source. So if you've got another account-based plan that is providing reimbursements, we have to have rules set up. Generally, those are outlined in the SPD about which plan pays first, because double dipping is not allowed. So now John's going to provide us with an overview of the non-discrimination rules I just mentioned briefly.
Thanks, Laura. As Laura had mentioned, non-discrimination testing, which many of you are familiar with, but just to provide a little background on, is one of the rules that the IRS imposes regarding FSA and all tax-favored benefit plans. For reference, we tend to use the term non-discrimination and discrimination testing interchangeably. They both mean the same thing, which is essentially making sure that benefits are being offered to and used by all employees in your company, and not simply for highly compensated or key employees, which we'll get into the definitions of in just a little bit. You'll notice that essentially on the slide, we call it a checks and balance. It's really just to make sure that something wasn't put in place simply as an executive benefit. There are other plans that allow those kind of things like company cars, but IRS tax savings are not the place for that. As I mentioned, we talked about who the prohibited employees are, and prohibited just means making sure that they're participating in an IRS authorized fashion and to a degree there. The two key groups that we're going to look at are key employees, and as you'll see on here, key employees are any owners who own more than 5%, any owners who own more than 1% with annual compensation greater than $150,000 per year, or any officers with compensation greater than $180,000 in the previous year. So I've noted 2019 because that's the previous year reference there. Officers are also going to be officers by duty, those that have the authority to bind the company, not necessarily officers by title. So a lot of times that's a question that comes up in testing, and it's one that we're happy to discuss with you and help narrow down who actually fits that category. On the flip side, for other tests, we're looking at highly compensated employees, which also include the 5% owners, both this plan year or last year, as well as any employee with annual compensation greater than $125,000 in the previous year. Now, a couple of things that we assume when we're doing testing, I'll show you here shortly the three tests that we focus on to determine non-discrimination status. Take into account a couple of assumptions here. The first being the eligibility to participate for employees, and that's equal across the company. So for example, you allow all full-time employees to participate versus only allowing employees that make a certain amount per year, that would be an obvious discrimination that we'd want to talk about, as well as contributions provided by the employer are equal. Those are two assumptions that we make in order to help make testing simpler for you. But as we've noted there, variations in this might be outside of IRS compliance, so we would want to look at those kind of things in detail. I mentioned the 3 tests that we use to analyze. These are the 3 largest areas where most plans have difficulty in passing discrimination for those key employees. I won't go into all the details of them, but essentially we're trying to make sure that key employees aren't using more than their fair share of the benefits, and specifically to dependent care, that both highly compensated employees and then specifically owners aren't receiving more of the benefits. If you've done testing with us before, you may be aware that the average benefits test there in the middle is generally one of the more difficult ones to pass. And this is an IRS setup to make sure that the benefit is being used fairly by all employees, which is a little tricky since only some of your employees may actually need the dependent care. But that's where we go into our testing process to try to make things a little smoother. If you've tested with us before, you may be familiar with in the past, we've asked for a full census, and that really is more time consuming for you to put together, and it gives us more information than we may need in order to do testing. So over this past year, many of you have probably received an email and been through our new testing process where we're trying to streamline it for you, make it less labor intensive so that you don't have to provide all of that employee data, but also to protect your employees so that you're not having to give that employee data if it's not necessary for us to do a testing determination. At the same time, we also want to maintain the level of support that our compliance team has been providing. So we want to make sure that we're answering your testing questions, and we don't want to leave you out just because you may not need testing, or you may not, your testing may be safe. We don't want to leave you out if you have questions about that. So part of the new testing process will be always sending an invitation to you in order to remind you that we're looking at your plan and that we are analyzing to make sure your plan is safe, but that if you have questions, we are always available to answer those questions at any time. And as I note there at the bottom, that we'll share the analysis of testing so that you know how we're working with you to fix that going forward. To give you a brief overview of the 3-stage process now, in the first stage, after we enroll your plan, we're going to send a testing email, and that's going to come from your account manager. That's to make sure that everything looks good for enrollment, but also so that your account manager can touch base with you and let you know that everything should be set up on the plan, and if you have any administrative questions, they're ready to answer those. Once you opt into that invitation email, then we will email you another link to our brief questionnaire, and this is generally going to help me make that determination for most plans. The questionnaire is designed to be about 5 minutes long with basic information that you already know about your company and about the employees at your company, but it gives us a snapshot photo that we can really analyze to determine whether we can let you know the status of your plan is safe now, or whether we do need to go on and do a full census to conduct detailed testing. But that questionnaire has really helped a lot of our clients be able to get through the testing process quickly and smoothly without as much information having to go to the full census. After this slide, I've got a sample to show you what that questionnaire looks like of just the kind of questions that we're looking for. But I've briefly lost mouse control, so give me a moment. There we go. So our testing, as I mentioned, it was really brief, 7 questions here. Simple things about about your organization. One, we want to make sure we're looking at the right group. But then easy questions like the type of business you have, that's going to determine your testing status. Making sure that we have your employee counts right so that when we're doing this analysis, we are looking at the right number of employees who should be benefiting from it. And then going from there just to make sure that all employees are treated equally, as well as identifying how many keys and how many highly compensated employees your company has, because we know that that changes from year to year. To give you a couple of examples of what we're looking at, here are two company profiles that I've made up with simple numbers there, just to show you how the questionnaire really benefits us. In the first example there, with a nonprofit corporation with no owner, we know already that there's no owners to worry about in discrimination testing. And with 10 employees earning $80,000 a year and 2 corporate officers there earning $100,000, we also know that there are no key employees to be concerned with. And everyone participating in all benefits, even if there's a dependent care, let's say this company has all kinds of kids, everybody is participating in the dependent care benefit, but since nobody earns more than $125,000, we know that this company is going to be safe on all testing. And we could do that simply by knowing these answers through the questionnaire rather than having to do a full census layout of all the benefits. Likewise, in the second example, we could assess that most of the testing would pass. We would want to take a look at that owner, but the good news is the owner can't participate in benefits by separate ownership rules, and so that would eliminate that employee. But then we also have 4 that earn more than $125,000 and 1 that earns $150,000. So even though we could eliminate the ownership testing, we would still want to look at that dependent care testing to make sure that is passing. And by happenstance, I've run the numbers on this, and it would because of those 5 employees, assuming all equal benefits for everybody. But that's the level of efficiency and streamlining that the questionnaire allows us to do to help make that determination a little bit easier for you as we work on that compliance. Now Laura's going to take back over and do a little bit of a refresher on health savings accounts.
Thanks, John. That's great information. I think we've gotten good feedback from our employer clients about the ease and the streamlining of that process for discrimination testing. So that's exciting. Talking about HSAs, I wanted to provide just a brief refresher for you on the HSA requirements, and then talk a little bit more in detail about the interaction between FSAs and HSAs. I think most of us are generally familiar with the HSA requirements, but sometimes we see compliance issues or questions come up when we're dealing with the interaction of FSAs and HSAs, and specifically HSA eligibility. When there is an FSA or a participant has been participating in an FSA and is now moving to an HSA, or an employer has only had an FSA account and is moving to adding an HSA benefit as well. So just as a brief reminder, these accounts are trust accounts, custodial accounts. They grow tax-free, so it's a great tool for employees for saving money for current or future medical expenses. They are individual accounts, so they belong to the participant. I know there's there's sort of a mind shift there for us in the benefits world. We're very used to thinking of employer-sponsored benefit plans, and HSAs are a little bit different creatures in that respect because they do belong to the participant. So the eligibility to contribute or receive contributions to a health FSA is determined monthly, and the general requirement is that a participant has to be covered under what's defined as a qualified high deductible plan. A qualified high deductible plan has set minimum deductibles, and maximum out-of-pocket limits. These are set each year by the IRS, and they're announced. Thankfully, they announce these sooner than the FSA annual maximums, but we also communicate these to you via one of our compliance updates. But you can see the 2020 minimums, minimum deductibles for family and self-only coverage, and then the out-of-pocket maximums. Individuals who are owners can participate in the health savings account. John just mentioned that, those folks would be excluded under the FSA. So that is one difference here between FSA and HSA, and sometimes a very attractive difference for an employer. Medicare recipients, so these are folks who are actually enrolled in Medicare, are not eligible to contribute. And this is an important point because oftentimes we have employees who become Medicare enrolled during the middle of the year. So this is a planning opportunity for those employees to make sure that they are not continuing to contribute to the HSA or receive employer contributions either once they become Medicare enrolled. There are also other types of coverage that will disqualify a participant. Generally, there can be no first dollar coverage under those minimum deductible amounts on the prior screen. There are some exceptions, for example, for preventive care. Under healthcare reform, preventive care has to be covered at 100%. So that is allowable, but otherwise, no first dollar coverage before those minimum deductible amounts are met. Some other examples of disqualifying coverage include general purpose FSAs, some HRAs, and then coverage under a non-high deductible health plan. So if you have an employee who's covered under your qualified high deductible health plan, and they are also enrolled in their spouse's PPO plan, that would make them ineligible to contribute or receive contributions. And I mentioned coverage under a spouse's health plan, but disqualifying coverage also includes coverage under the FSA or HRA of a spouse. So a lot of times this is really an educational opportunity when you have an HSA to provide education to the participant employee about things that are really outside of your control as an employer and your knowledge, oftentimes, that think they can have coverage under other plans that can result in being disqualified from HSA eligibility. I do want to reiterate that the key is enrollment. So it's not just mere eligibility. So the fact that your employee is eligible for their spouse's PPO plan won't make them ineligible for the HSA, but if they actually enroll in the PPO plan, that would cause there to be disqualifying coverage. So one of the things that sometimes gets forgotten, overlooked, or maybe an area that there are issues that aren't considered before implementing an HSA are carryovers and grace periods and how that can affect an HSA, HSA eligibility. And this is really important if you have previously only had an FSA and you're adding an HSA, or if you have both and you have participants who are moving in between the two plans. So one year, the participants in, say, your PPO plan with an FSA, they decide the next plan year that they want to move into the high deductible plan and have an HSA. There are things that we need to be thinking about in those scenarios. So as a reminder, the coverage under a health FSA or an HRA results in the participant being ineligible for the HSA for the entire plan year. That's even after the balance is exhausted. So if they're midway through the the FSA plan year, they've spent all of their FSA money, they're still going to be ineligible to contribute to an HSA and to set that account up. If they have an unused balance at the end of the plan year and your FSA has a grace period, that will result in HSA ineligibility continuing until the first month after the grace period ends. So if someone has, let's just say $200 left in their FSA at the end of the plan year, and there's a grace period that they have additional time after the end of the plan year to incur expenses, they're going to continue to be ineligible to contribute to the HSA, even if they enroll in that high deductible health plan at year renewal. If they have a zero balance at the end of the plan year, they will be HSA eligible. That's even if there is a grace period under the plan. If that participant has no money, if you've got a calendar year plan, December 31st, they have $0. Even if there is a grace period, they are going to be eligible to contribute to the HSA in the new plan year. So really, the important takeaway here, if you've got a grace period FSA, is participants need to spend down their FSA dollars if they are planning to move into an HSA, or if you as an employer are adding an HSA and they think they may want to be in that plan, they need to have $0 at the end of their plan year in order to be HSA eligible. So the run-out period is not going to cause HSA eligibility issues because remember, in the run-out period, they're submitting for reimbursements for claims that have happened during the plan year. So the grace period allows an extension of time for when claims can be incurred. So there is a difference there. So for our carryover FSAs, carryovers to a general purpose health FSA is going to make the participant ineligible to contribute to the HSA for that entire next plan year. So again, great talking point, great education point. Spend your FSA dollars if you want to be eligible for an HSA. It is possible for employees to waive or decline the carryover prior to the beginning of the next plan year to preserve their eligibility. However, that might not be as attractive to an employee because, as you recall, FSA dollars are employee dollars, so they're really losing money that they have had withheld from their pay that has gone into the health FSA if they do that. So that might not be the best option or the most favorable option as far as an employee is concerned, but it is an option to preserve HSA eligibility. Another option, and this is probably more favorable from the employee's perspective than the carryover, or declining the carryover, is to carry over the FSA dollars to a limited purpose health FSA. And you can set this up so that it happens automatically. It can be by election. But again, this is an area where there's opportunity for communication and education for the employee, because a lot of times what we see is the elections into a limited purpose FSA might be often lower than a full FSA because the expenses are limited. So the participant may not have as many dental and vision only expenses as they would have a full 213D expense. So they may not want to carry over $500. So there's an opportunity here for the participant perhaps to lower the amount of the carryover if they're concerned about having $500 go into the limited purpose health FSA. And just as a final caution, this is an area where it's not entirely clear if this type of change is allowed, where you're allowing an employee to make a mid-year change from a health FSA to a limited purpose health FSA. And I see this most frequently when employers have their health FSAs on typically a calendar year basis, and they've got their health plan renewing on a different basis. The employee was previously in a PPO plan that was allowed them to participate in the FSA. They elect at renewal to enroll in the high deductible health plan and then want to enroll in the HSA. So just note that that's an area where it's not entirely clear if it's permissible. We're sort of borrowing from other guidance. So something to think about, especially if you have a calendar year FSA and a fiscal year health plan. So we've got the HSA contribution limits here. One of the things that's important to note is, again, these limits are determined based on eligibility, which is determined on a monthly basis. So if you have someone who is not eligible for the HSA because of the health FSA or some other disqualifying coverage, you can have the situation where the participant contributes too much to their HSA. And if we could move to the next slide, we're going to talk about what can happen when you have contribution errors. So the general rule is that HSA contributions are non-forfeitable. And what that means is once the money's there, it's there. It doesn't matter where that money came from, if it's the employer contribution, the employee contribution. Once it hits the HSA account, it can't be recouped or returned. There is an exception if there are mistaken contributions that can be corrected or recouped in very limited situations. So one example of this is if there's a mistaken initial eligibility. So the person was never eligible to establish an HSA to begin with. That's one situation where the mistake can be corrected. Another is if there's clear evidence of an administrative error, and there are very limited scenarios regarding the administrative errors as well. I'm not going to go into those in great detail given our time today, but just understand that there are very limited situations in which mistaken contributions, whether employee or employer money, can actually be recouped out of the HSA. If there's a mistake and we can't recoup that money or reverse the error, then you can have the situation of excess contributions. And excess contributions carry substantial, tax penalties in connection with them. So the contribution that is in excess of the limit would be included in the person's gross income. So it's not going to be deductible, either the employer portion or the employee portion that is included in the excess amount. There's also a 6% excise tax that's cumulative, in addition to the income tax inclusion. Now, this excise tax can be avoided if there is what's referred to as a curative distribution of the excess contribution and income attributable to that before the deadline to file the tax return for the individual. So it's generally April 15th. But you can see here, once we get into the situation where we've got an employee who either was eligible and then lost their eligibility, or perhaps they weren't eligible for 2 months of the year because there was a grace period and they were contributing to the HSA anyway. Once we step into the contribution errors world, it gets complicated. You know, these are conversations that we need to be having and things that we can help you walk through and figure out, is there an excess contribution? Is there a mistake that can be corrected? How do we go about doing that? And if there's an excess contribution, what should the participant do, or what can they do to minimize the tax impact, so to avoid that 6% excise tax? And the contribution errors aren't just errors that exist in a vacuum. They're going to impact tax forms that are then provided to the IRS and provided to the participant. So I just wanted to raise, these are just a couple of the reporting forms that are impacted by contribution errors. The first is the form 5498, and that form reports the contributions for the year and the fair market value of the account. So if there is a mistake that is corrected, and the money is recouped from the HSA, that's going to impact this form because it's going to ultimately reduce the value of the account and the contributions that have been made for the year. Form 1099-SA is a report of the account distributions. This is filed with the IRS and provided to the participant. So if there is an excess contribution distribution to avoid that 6% excise tax, that's going to show up on this form. And then the last reporting form is the W-2. So we're going to have the excess contributions going to be included in the participant's income. So that's going to need to be reflected on the W-2. So there are lots of the analysis when we get into HSA eligibility. If there are issues with that and there have been contributions, it's a complex analysis that's going to impact several different areas, and including these forms. So we really need to take care in looking at these issues if we can prior to introducing these accounts, or once they've been introduced and we discover these errors, working with us to help you figure out what's happened and what needs to be corrected, or if it can't be corrected, how the participant can take a distribution to avoid that excise tax. So if you run into any of these situations where you're concerned about an excess contribution or mistake, or you think there might be an excess contribution or a mistake, please do reach out to us so that we can help you through that. And that is our presentation for today. Just as a reminder, I know we've talked a lot about FSAs and HSAs today. We also provide administration for HRAs, COBRA, POP, Transit, and also ERISA compliance services of Form 5500 preparation and WRAP SPD prep. So our compliance team is here to help you in any of those areas, including the ones we've talked about today. If you have any questions or you run into any issues, we're here to provide support to you and your team.
Thank you, Laura. It looks like we've covered all the questions submitted through the question box. Anyone's welcome to submit a question now that we'll take care of in the next few minutes. Otherwise, you can submit your questions or comments to compliance@probenefits.com. As always, we'll provide you a copy of the slides along with an audio recording of or a YouTube link to the session audio and slides in case it would be helpful to you or any member of your team. Thank you for your time today. Thanks to Laura and John for an informative presentation, and hope you have a great rest of the day.